All right, welcome everyone. And you probably caught me going through just a little bit of a list of things that we want to discuss today and just kind of looking over a glance at the markets. Been an interesting day, been an interesting week, that's for sure. And how about just overall an interesting year? It almost seems, before we begin, I want to double check, make sure the sound quality is good. I don't want to be blasting anyone out of their chairs. So let's get that volume adjusted. It looks like the meter's looking pretty good. The sound quality's not bad as long as I don't move too far from the mic. You would think after about a couple decades I'd get the hang of learning how to do all this kind of stuff, right? So this is actually going to be, if I'm not mistaken, if not the last public webinar we conduct. It's it's Pearl Harbor Day. We want to give thanks to all our veterans out there, and for those from Pearl Harbor. What a time, right? So December 7th, what a day to do a webinar. We get into next week with Hanukkah and the beginning of the holidays. After that, winter begins, if believe it or not, the 21st, and then we have Christmas. So money to be made in the market after tomorrow we have on the 8th, because of the way the holiday was and the government with Thanksgiving, etc. They delayed the monthly unemployment report, as I like to call it, unemployment report, that is. The monthly U.S. unemployment, giving us to see if more hires, but the key word is wage cost inflation. If we see increase in overtime and increase in wages, that would be slightly inflationary or good for the Federal Reserve to move ahead with a rate hike, which the first day of Hanukkah is going to be a gift by the Federal Reserve with at the least a quarter-point rate hike, which is on December 13th. So looking ahead into next week, and tomorrow, what do we have looking forward? A lot of things, believe it or not. Everyone thinks, oh, it's a big holiday, and things begin in December. We still have, of course, the government's not going to shut down. I mean, this has been going on since I was 21 years old, trading when I worked with Uncle George. That's George Lane, to many of you who may know his indicator. He created stochastics, which is who I got my start with. But before we get into figuring out where the markets might go and looking at some seasonal trading strategies, we're going to go over where they've come from and do a top-down approach with you guys, show you what the algo system's doing, some interesting, neat stuff in trades, especially in the VXX, and I think what everyone, it just seems to be, even, I mean, it's got to be a bubble, and I'm not joking, and I'm not exaggerating. My mom, God bless Mom, and like many of us in the audience, we struggle with elderly parents, and mine is in assisted living with dementia. But she did ask me about this Bitcoin thing, how many coins makes a dollar. It was kind of, I didn't know how to explain the cryptocurrency thing to her, but when Mom's asking me about Bitcoin, you know, I just got to, I'm sorry. I don't even know why I even shared that with you guys, but before we begin, let's get into a risk disclosure statement here. If I will move forward, there we go. Just remember, trading is risky, and this presentation is for educational purpose in nature. Okay, so as we move forward. Today, what I wanted to cover, my outline for you guys today, is to look at a couple seasonal market tendencies and look at some seasonal market analysis, and if it's even valid for the rest of this month or the rest of the year. We know that we're going to have some cross currents which would normally take place from a seasonal perspective of traders not wanting to take profits, you know, on higher valued markets they were long. We know that there are times when there's markets that are down on the year. They tend to stay down on the year, but yet progress higher going into the middle of the second quarter or the first half of the next year. So let me rephrase that. Markets that are up on the year tend to stay up on the year to a degree until after we get through this mid-January break. Profit taking to help defer taxes. If you sell in January and take a profit in January, You don't pay your taxes until April of 2019. Take a profit today, you're paying it in April. Take a loss today, and you're writing that off for the 2018 tax deadline. Okay, so that's that cross current. But with more and more people in 401k and IRA accounts, I don't know if that's something that's been altered to a degree, and as well as this whole thing of what's called passive investment, where people are buying funds rather than individual stocks, levered, DTF, and options. This has been it certainly is an interesting cross current of the market. So seasonal analysis, those are the things that we come to when we go into December. Not to mention, if I didn't, we've got the Federal Reserve, and I think I already did mention, which on the first day of Hanukkah, Wednesday, December 13th, next week, the Fed will raise rates a quarter point. If they don't, I don't know how the market would react to that. I mean, it's pretty much priced in. So, I mean, if they say they're still not concerned about the economy because inflation is low and they don't decide to act, I'm not sure how the market would react to that personally. On the other side of the coin, if they said, hey, there's a little bit, inflation is picking up, we're concerned, we're behind the 8 ball, we're going to raise a half a point, not a quarter of a point, or we're going to increase Fed funds and also increase maybe the discount rate, cut back on bond purchases. I mean, there's a lot the Fed can say and do at this next meeting. So it's something to be aware of and not to be taking, so to speak, a vacation and an ear away from the market next week. So today we're going to look at some stock and some sector analysis and look at some tools to help for picking stocks. Now, in life, just like this market seems to have acted, logic is often ignored. And I also share this because I gave a presentation to these in the UBS conference at UBS in their headquarters in Zurich several years ago. And as I was walking in there, it said no food, no drinks, only water. And I'm like, isn't water a drink? I mean, so either they don't want their traders drinking hard booze in a conference, which I don't know, maybe that's not a bad sign. But anyway, no food, no drinks, only water. It was kind of a cute sign. And I don't know, being a more of a logical thinker, I thought, boy, that's kind of strange. So anyway, logic is often ignored, and I think people let emotions rule and ignore logic, and that might be what's been going on with this market. But if we're going to kind of figure out where markets have been or going, we got to figure out where they've been. And what's the, what I wanted to give you an idea into is the best performing sectors on a year-to-date basis, and then the worst performing sectors on a year-to-date basis. And here we have, believe it or not, kind of weird, security and alarm services is the best subsector, home building, ITB, Lennar, Toll Brothers, home entertainment, seems like home entertainment software has done very well, and then again, semiconductors. And I'm sure if you're not familiar with a company called NVIDIA, that's a different story, or Micron, MU, casino and gaming, believe it or not, even after that despicable, evil event, atrocity that occurred with the shooter at Mandalay Bay onto the crowd. MGM's done relatively well, as has Wynn, Caesars, and Las Vegas Sands. So good times are bad. People drink booze, so distillers and vintners are doing well. Technology, healthcare supplies, hotel resorts, cruise lines, and application software. So throw in Adobe, et cetera, et cetera. Worst performing, still, oil and gas, the XOP. Obviously, even with the bump up that we've recently got in Macy's, Nordstrom's, department stores, they're still second worst performing. Electrical equipment, housewares, oil and gas, the OIH, and in specialty stores. So retail is still not done that well. So when you take a look at the last 13, that's a year-to-date basis, though. So on a year-to-date basis, if you were a contrarian, you'd say that might be overdone, and this could be underdone. So maybe we come to a switch in what was strong, cyclically speaking, maybe going into by the end of this month, we start looking at maybe some hedges or some options for. I know a lot of you guys are Thinkorswim fans. You guys use the PPS indicator, which is on Thinkorswim's platform, to run your scans. And I think as we move forward going into 2018, we could see a reflection of a shift of what was overvalued. It's subjected to profit taking, and what's undervalued could be set up for some decent buying going into the first half of next year. So right now, because of the anticipation of interest rates, when they go up, banks benefit. You notice that the last time the Federal Reserve raised interest rates, most banks did not pass that rate hike on to deposit holders. In other words, we didn't get that extra 0.25% to earn interest on our accounts. So eventually, maybe we'll see that. And if so, the higher interest rates go, we earn interest, we take more of a less risky investment off the table from equities and put it into maybe mutual funds or CDs, believe it or not, one day. I'm not sure it's not this day, but maybe one day over the rainbow a couple years from now, we'll find out. Diversified financials, and you can clearly see what's really done well. But so in order to essence to gauge where should I start looking at the markets, if I can say, well, where have we gone in the last 13 weeks, more or less, if you think about what does 13-week represent, it represents the last quarter. So what has the market, what's been the best performing sector in 13 weeks? Banks, semi-still, retailing, which we just kind of said from a year-to-date perspective is down, transportation, automobiles, and let's just jump straight down to the bottom of the list, media, biotech, drugs, life sciences, and then food and beverage. So we kind of want to look at some of these changes that we've seen in the market, because this is a very good representation of the term that you've been hearing and we've been teaching and talking about for several years now. It's called sector rotation. The market seems to be like a swarm of locusts. It goes to one field, sucks it dry, moves on to another. So with that said, I think one of the things that we look at is seasonal analysis. And this year, right now, in 2017, a lot of stocks and a lot of sectors did not adhere to traditional seasonal tendencies. And one of the main reasons, as bullet point number 2 looks at, it says stocks, commodities, foreign currencies have a strong tendency to demonstrate seasonal patterns, but these moves can either be muted, not happen, or magnified depending on A, economic turmoil, not much of that lately, political events, lots of that lately, monetary, not a whole lot of that really efficiently, and then fiscal policy stimulus changes, and we have one on the table right now called tax reform. So those are the things that can alter and change the way seasonal tendencies impact markets. But generally speaking, they do alert us, and what I like to teach people is if a market has been in sync or been working with its seasonal trends in recent history, if it's coming up to a seasonal change, I give it a high probability, since it's been in sync with seasonal tendencies, it could remain in sync with its seasonal tendency. Stocks and sectors that have been out of whack, I don't trust it until I start to see that seasonal tendency work over a period of time, and generally it's at least a 6-month or 2-quarter basis. So typically, here's kind of like what we see with the equities from a year-to-year basis. You get that October, that late August, September sell-off into October, and then we bounce around in November, and then we go down to the first week of December. I guess, if anything, you want to say we did get a mild little pullback off the market, and then as we go into January, we get what's called that Santa Claus rally. So if this was the little sell-off that we just recently experienced, and so let me share with you what I'm referring to. And let's change that symbol up here. and we'll look at the spiders, if that's all right with everybody. All right. So we just had the market provide an upside move, and then as everyone can kind of see, where's that little 266 down to 263? If that was our seasonal decline, wow, we still got a little bit more, or at least back and fill into the market. So we'll go over what some of these readings are, but that's what I'm referencing about the that seasonal up and down boingo of the market. But typically, bottoms form on average the third week of the month of December of November, and then go up into the end of the year in the S&P. Now, here's the S&P using Genesis Trade Navigator software. And the reason I love Genesis is because it has all types of amazing tools on it that I like to look at. And I'll explain what each and every one of these tools pretty much represent. First tool that we see up here is the person's pivots with the PPS, and this is a weekly chart on the S&P 500. So you can see that the green arrow pointing up would mean we're in a buy mode. This is on balance, this is the on balance volume indicator, and this is a seasonal trend. And you know, pretty much you can see that the market has that little upside rally, has a little pullback. So if that was the little pullback, then you know, we could anticipate some upside. But one thing I want to caution and just alert everybody when someone says we just did a 3-day seminar down here in Florida and it was an awesome event and really people were engaged and we had some great times. And amazing questions from the audience. So these are not newbie traders. These were some advanced traders. And I picked on one gentleman in the front row. And if he's here today, you know, I did it out of love and kindness. But I kept saying, you know, anytime I point, I want you to tell me what's changed, John. Well, here's what's kind of unique and different. The indicator at the very bottom is called the Commitment of Traders Report, the CFTC COT. Now, some people like to teach to look at the commercials and the large specs, and I like to look at the small specs as well. What's really interesting is that the small speculators actually started to go long the market for the first time all year. If you look at the last time they were long, was back in December of 2016. They went long the market and then they've been short. If you notice, this is a zero-line histogram in the marketplace. They have been the green as a net, as a whole, as a group. I'm not saying all small speculators have lost money. I'm saying as a group, this category has been short the market all year long since last December. What's new? What's changed? What's a red flag on my books? The small speculator just decided a couple weeks ago, as you can see, to get long in the market. So they are now long the market and they're probably feeling pretty good. And that's what's changed. It's that the small specs just started buying the market here after a whole year of selling all the way up. Now, let's take a look at some sectors and say, well, what does the market look like that weighs in on the S&Ps and then the NASDAQ? And one is technology. So we're going to take a look at top-down approach. We just saw the S&Ps. Let's go down a notch and look at individual sectors. And look at the condition of the market as well as the seasonal tendencies going forward for the rest of the month. Now, the funny thing is, this is technology, the XLK. As the market started to rally and make a new high as the public was getting long, notice for the first time ever, we got a pretty decent sell-off in XLK. And as the market started to move up, and you can see clearly a newer high here, the volume had lower follow-through. Seasonally speaking, this is kind of like not a great time to start buying technology. This next chart down below, this little red line graph, this is what's called in terms of percent change, it compares the underlying product, and in this case it's the technology XLK, to the performance of the S&P 500. Quite frankly, here's a divergent situation. As the market was making a newer high, the relative strength was weakening against the overall market. Price is going up, but it's weakening against the market. Another red flag. Next is XRT, and we're all familiar with the fact that people aren't shopping, the malls are dead, and it's just going to Amazon. But recently, I mean, even reporting yesterday, Lululemon reported some pretty strong sales. We started to see electronic Best Buy take off. We've seen Kohl's take off. We've seen Ross Stores, Burlington, a whole assortment of different retail, Abercrombie and Fitch, so into Nike, for example. So all of a sudden, it's the trade's coming back. Now, here's the funny thing, gang. In the XRT, in the retail Spider ETF, which has a good weight with Walmart, Costco, and Amazon, of course. But this is a sector that generally doesn't do great until about the third week of November and starts to go up. And I mean, this thing, not only did they get in on it slightly early, but the volume trend of this breakout is pretty strong. And as you can tell, the relative strength of the market, this is probably a sector going forward into January that we're going to continue to see more upside. Now, the person's pivot indicator is showing a very bullish bias for this next month. So for the month of December, we're looking at a projected higher high and a higher low. The green is the predicted support and the red is the predicted resistance. So XRT, we're looking for further upside. And so I think going forward from a seasonal perspective, it's been in a seasonally weak period of time and it went down. It's in a seasonally strong period of time and it's gone up. And the conditions of that rally validate or support buying dips in this sector of the market. Okay? So XRT is one. Now here's the banking index, and this is kind of crazy. And this is very crazy because the Federal Reserve is going to raise rates next week. Everyone knows it. And the bank index, this is the BKX. Now, it's an index, so there's no volume, so I can't show you volume trend. But from a seasonal perspective, this is ironic here because maybe the market's at a pivot resistance target. The relative strength comparing the overall bank index to the market, it's actually weakening. So seasonally speaking, this is a conundrum because maybe perhaps the bank sector has already built in the event that's coming out next week, which is a rate hike. Now, let's nail it down a little bit because there was a bill that was passed in the House or is on the table to be passed allowing small banks, regional banks, to benefit and relaxation in some regulatory requirements. Now, here's the problem I have with that. Now, from a perspective of seasonality, typically in December, this space goes up, and it got cut off on our screen, but that's kind of a seasonal trend that ends for the regional bank sector. Now, here's an interesting aspect that I want everyone to kind of pay attention to is that we have a higher high in price in an ETF relative to the overall market. It's underperforming and the volume is not there. So maybe people are waiting, but my idea is that if the regional bank sector has any further follow through going into next week towards the end of the month, if this volume, if it moves any higher and there's no corresponding volume to support the rally, I'm suspecting it's going to see a nice correction after the first of the year. So you want to pay attention to some of these subsector ETFs, such as the regional banks. Now, let's move on with the weakest sector on the planet as we identified on a year-to-date basis, and it's energy as identified by the subsector of the oil and gas exploration ETF, the XOP. Gang, it doesn't do too well. It chops around. The relative strength compared to the S&P is very bad. This is a weekly chart now, so day to day it's up and down, and it is trading up against a person's pivot resistance level, line in the sand. So this is a chart that we may see since we've got to build in inventories, but you know, you could look at the fundamentals and look at the inventories. What I like to look at is the crack spread, and that's the difference between heating oil, reformulated blend gasoline, and crude oil. Quite frankly, we had a significant build in the products, meaning heating oil and gasoline. So think of the logic here. Again, logic. If refiners have full capacity, they've refined and they've made all the gasoline, jet fuel, diesel fuel, they've made heating oil, and now they're just waiting for consumers to drain that inventory, and then they take crude oil, buy it, or restock, and then do what? Refine again. They make money. If demand goes down and nobody's buying reformulated blend gasoline or using fuel and depleting supplies, then crude goes down, refiners don't make as much money, and we see a decline in the XOP. Less people drive. Maybe you get that little over the hill and through the woods to grandmother's house we go syndrome for Christmas, but after that, gang, you see a potential decline, refiners shut down for the holidays, etc., etc. Seasonally speaking, this sector is a dog. It doesn't do well. Relative strength-wise, it's a dog. It's not done well. So I'm thinking we have a very strong potential to see the market pull back, and it depends on that volume. We could see a pullback in the XOP to maybe back into the 30, 31 handle, which is where next month's support exists. Right there is that green line exists. So you want to be aware of that. All right, biotech. Yikes. Now this is a scary one, and this is a conflict between what may take place between, you know, the government with, again, fiscal policy changes. But if we take a look at this chart from a technical perspective, the biotech sector ETF, IBB, has had a nice rally this year with no volume. It's in a seasonally strong period of time, and the relative strength is significantly underperforming the market. So having exposure to a lot of biotech right now is probably not a good idea. The one single saving grace, one, is that we do get an end of the year push to the upside from a seasonal perspective. The other saving grace I want to point out is that we are right up against a strong shelf of what would be considered old resistance and new support. So I would be scanning to see if we get, just like I tweeted out a while back on that sell signal way up here, we tweeted out we had a whole bunch of sell signals in the biotech. I'll be looking for scans to find out if we get some new, fresh buy signals in the biotech. Now I'm switching over to a live platform. This is my TradeStation John Person platform, and I'm going to go to biotech, and it should be right after, right somewhere here, after consumer discretionary, retail, department stores, healthcare. Here we go, and now biotech. Now, here's what this radar screen is kind of sharing with us. It looks like it's kind of like Christmas time. We got blinking green, we got blinking red. What that means is, for example, Sarepta Therapeutics and Juno Therapeutics. Juno, it's blinking because it generated today, it's warning me that Juno Therapeutics generated a daily PPS buy signal. So it would be really a nice event if we had more stocks other than Juno and, again, PTC Therapeutics populate daily buy signals. Here's PTC, by the way, and what it looks like. After today's price action, it generated a daily little buy signal. The only problem is it generated a buy signal against that gray line, which is resistance. So two stocks in a sector does not tell me sector strength. It just tells me two stocks did pretty well, and that's about it. I want to see more stocks in the sector start to generate buy signals and not sell signals, like Amgen just generated a fresh new daily sell signal for tomorrow. So if you have a sector that generate weakness or sell signals, it doesn't breed confidence that the sector's strong. So what we want to see is more stocks, even though they're positive, the net change today was positive, they didn't get an algorithm buy signal and change up. That to me is kind of an issue in what we're looking for. We're looking for these stocks and these sectors to generate buy signals and start to lift off. Okay, that's the key element that I'm looking for. All right, so biotech is supposed to be seasonally strong, so it's on a watch list right now. We're looking for the sector and more buy signals to populate daily or intraday 60-minute buy signals, and look for some follow through. If we get that, then maybe Santa Claus will be pretty good to the biotech sector for year end, and we get a lift off in the IBB. All right, now gold. Gold got smacked. It got decimated. It got slapped around. Let's take a look at gold. Even on a 60-minute basis, and this is and I'm going to share with you the results. It has done literally this year. This is a trade algo optimizer, and many of you have this already. We have not been mass marketing this because of the fact that there's some circumstances behind marketing this to too many people. But just to let you know, the position size, I'm going to just give you the general gist of this. This only trades 2 contracts. So this is the looking at the performance strategy overnight on gold. Just as you can see, it's just 2, 2, 2, 2, 2, 2, 2. And yet it was short gold. It's a crime, but it happens in algo trading. The parameters, it had a stop. It says trailing stop. As you can see, there was a trailing stop feature, and it popped out the short trade from almost the high. So that was El Stinky Poo. I'm going to be honest with you. The good news is it didn't go long on the downdraft yet, at least buying a pullback. And this is based off a 60-minute algo system program. Now, why do I share that with you? Because while gold got smacked down today, and the way it traded lower into the overnight session, so the algo system, by the way, has a function in there that says if you get short, but it's above the normal risk, 500, 600, whatever the program has optimized, do not take the trade because it's outside of the risk parameters, and it'll miss the trade. And that's okay because there will be another trade, right? Here's the thing about gold, and I want everyone to kind of look at, because gold, as bad as it is, and it is at an important support. It's got better support just around the 1240 and the green line right here, 1225. Now the volume in the OBV started to kick in high gear today and showing some relative weakness. The relative strength against the S&P looks uglier than the Dickens. You can't lie about it. It's straight down. But here's something that we want you to be aware of. Regardless, the market finds itself on about the 15th of this month. Gold has an annual and a long history, and I mean a long history of seasonally bottoming out. So we're going to be watching to see if gold starts to generate buy signals in that December period. Like here, if you look last year, the market generated a sell signal. The relative strength was pretty ugly. Right into when? Just about the same time. Look, between November and January, right there in about the middle. And then you got this big upside. So it took everyone out, went down, looked ugly. The volume was ugly. It was just going down. And then all of a sudden, a big upside move. So I want everyone to be aware that gold, there are some certain changes that will take place in the next 2 weeks. So maybe the market's selling off in anticipation of higher rates, a stronger dollar because of the Federal Reserve. But boy, by gosh, you can't argue with, maybe it's sell the rumor, buy the fact, and you want to look for that year-end push for gold, which typically lasts through the end of February. So I wanted to bring that to your attention, okay? So if you're seeking to succeed, it's been my goal for decades to help teach people how to trade. We give you setups with the right tools, setups helping you with trading directional moves, obviously comparative relative strengths, important to understand, and teaching how to use the best indicators that are out there as well as seasonal analysis. And we always do that at a dynamic price. Now, before I really get into anything, I just wanted to point out to you, we offer course manuscripts, video modules, live trading, live Q&A session, newsletter support, market video reports. We have advisory service, trading online courses, and we are coming out with a year-end Christmas catalog, so look in your emails for an offer and go through and take advantage of some of that. What I'd like to point out to you is a couple features and functions that is in one of the trading course, and again, the person algo optimizer, and that is this couple of these products here, which is the VXX. Now, this volatility index product right here, something that we've been trying to teach people, and if you saw me at the, when was that? Back in May in Las Vegas, the May Money Show. People weren't familiar, they were familiar with volatility products, but they didn't quite understand them and how they're trading and the liquidity that it offers, and what this is, an ETN, an exchange traded note. Now this is a product that's destined to go down because it's an ETN, which is an exchange traded note that's traded off the futures. And the futures are always priced higher in the future. Why? Because the market's anticipating some kind of a black swan event to occur down the road. And as every day and every hour and every week passes by, there's no major event, there's a contango is the term, and it gets that volatility or the contango pricing gets crushed and this thing drops. Now every once in a while you get a scare in the market and it goes up and then the scare's over and then it comes right back down. So trading the VXX on signals. Now today when we came into the trading community and I told everyone, hey, this thing's short, and then all of a sudden it went down, I'm like going, I'm praying right now because I'm a little nervous, it takes a profit. So it did take a profit. And that shows that the position was short and it's flat. The other thing that I wanted to point out was other products that I know Bitcoin is one heck of a, and if you're not familiar with it, I think this is one it's not a trade like the S&P 500 or the spiders with the volume, and I think I already shared with you this, the average daily volume on the Bitcoin ETF. If you look at GBTC, the volume today was 237,000. So if you're thinking you're going to throw off like 500, 600 contracts, first off, God bless you for trading that kind of equity on that valuation of a product. This is more like 5s and 10s type of trading. The average 10-day volume is only 85,000, but it is a way for you to play in the Bitcoin arena before the futures, something that you can also utilize and follow with our signals. And that's what's been very instrumental. I wanted to cover the Bitcoin situation or the GBTC because I sent a tweet out the other day, and by the way, our system was long and it got out. And as you can see, since it got out, it's been trading back and forth. Let me go back and look at the intraday as well as the end-of-day analysis. It's had better moves, and the relative strength, as it starts to rise and that relative strength starts to fall and the volume starts to, the momentum of the volume starts to go down. I mean, I'm not going to predict the exact high, but it certainly is a warning signal that things start to change. We don't quite have that on the daily chart, but we do have an interesting scenario developing in the Bitcoin right now on the intraday 60-minute charts. The last couple days that this thing's been going up, it's been going up on divergence of volume. You can see this last leg to the upside was on stronger volume. In terms of percentage, not actual volume, that's what this volume indicator is sharing with you guys. You can clearly see that the market is rising on weaker volume, which is really bizarre because the volume actually started to drop towards the close and go negative as the price was kind of holding in there. So Bitcoin, to me, at this level, now the system is flat. It's not long, it's not short, it's just flat. Now, I would guess it will, unless we get a sell signal and we cross below what's called the last conditional change, and for whatever reason, my volume, my drawing tool has been disabled, but things seem to be working perfectly right now, so we're not going to change anything. But if we start to break below, and what's really kind of what we wanted to start to follow and watch on a product like this, is it working technically? Can you use technical analysis on a product, right? Are the buy and the sell signals working? And that's what's kind of key, other than trading with an emotional, I got to get in this thing. And again, as we've all should have learned from 2000, you might bet that it's not going any higher, but guess what? It can go up a lot further than any one of us ever suspects. It's gotten some credibility because of the CME and the SIBO. The exchanges are going to launch a contract on it. I've never been one to say it doesn't belong in society. Quite frankly, I don't think it's going anywhere, but the question begs, is it worth what it's at right now? And when I start to see products start to trade with that type of volatility where they open near their highs and they trade down and they go back up and they trade back down and they try to go back up and the volume starts to weaken, that's the red flag, and I wanted to share that with you. Now, I cannot use seasonal analysis on this because it hasn't been around and trading actively enough for any seasonal tendencies in the market, but I think it's key critical to have pointed out that, this, looking at the 15-minute chart, you can clearly see gaps up, and someone's interested in selling this thing as it gets up near these highs. So it's finding what's called distribution. It's finding supply all of a sudden. So with Mom calling me up asking me, oh man, the good news about that is hopefully she won't remember asking me the question. So I won't have to explain cryptocurrencies to Mom. God bless Mom. But for you guys in trading, I mean, it is an exciting product. As traders, we need stuff to move. If we don't get movement, it's tough to trade. And if there's no liquidity, you can't get in, you can't get out. That's a problem. But we have some exciting trade potentials coming up for 2018. We absolutely have exciting trades as we get into the last week of the year. I personally stopped trading everything at the last week. I don't like to trade during the week of Christmas to New Year's. I call it the rookie period. People are at home, they got nothing to do, and then they start trading, and no one really wants, as an institution, to start putting on heavy positions before if their year is made. I mean, it really is kind of a wishy-washy time frame to trade. So you need to be a little selective. As we move forward in looking at particular trades and opportunities, what I would say as far as the Bitcoin is concerned, this white line in the sand is what we call that last conditional change. If we start to see over time, and this thing's not afraid of going short. I mean, it's been short, and I think that's exactly the kind of setup, the same setup that I'm looking for just on a grander scale. As you can look over here, volatility took off, it came down, it went up, it generated a sell signal, and then the gosh darn thing went short off the signal, And unfortunately, it didn't buy back on the absolute low, but it had a trailing stop or a max bar feature. See, it says max bars. It got out on the maximum bar. So as far as a trading system or execution is concerned, the person algo optimizer, at least seeing that it can work on markets such as Bitcoin or the GBTC is I don't know, a pretty neat thing. Other products, just to leave you with, that we've seen some success with, and this is Tesla, and this is a little model that trades Tesla, by the way, and it scales out. That's why you see two blue lines. It gets in, it gets out of half the position at a profit target, and it trails the stop on the balance, and then gets out on a regular feature. The equity curves been all right. The funny thing is, it was long. It took a small loss, as you can see right here. It went long at 308. It got stopped out at 304. And it just went short, by the way, Tesla. Just went short at 313. The funny thing about Tesla is it's not been around long enough for a good seasonal study. But it's in that kind of scenario where it's in that technology space that tends to weaken through the year end. So I'm thinking it's tied in, and I'll be watching to see if as we start to progress tomorrow, the next day. Now keep in mind, there's no shame in getting a short. If this thing's wrong, it's going to get out faster than I can turn my head. That's what's great about an algorithmic quantitative trading analysis product. It gets you in. It has defined rules such as trailing stops, or it has just LMO RFN, get me out right now. So right now, currently, it has a nice yield on the year-to-date performance. And so therefore, I just wanted to point out to you, gang, this is something that I think going forward, if we can start to see volatility appreciate, starting to see price ranges. We went through a very, very abnormal year because everyone kicking that can down the road. We wanted to see healthcare reform. We wanted to see tax reform. The first year of a new president. I'm not making any comments politically. I'm saying just the first year of a presidency, you see changes. Instead of watching CNBC, you watch C-SPAN and see what changes are coming out of Congress, what things are getting out unwound. We did this years ago, if you recall, when they had that ethanol push and that ethanol vote. And then, of course, Dodd-Frank, and then there was those changes. And then we saw the changes in where money flows went. I was always taught, if you want to find out where the smart money's going, pay attention to what's happening to Washington, D.C. And that's really this market is on and has been on pins and needles. And I know there's a lot of debate about the overall economy, globally speaking, and I'll address that in just a second too. But one of the things that I want to address was in the Treasury bonds today, and I know we got some guys in the room today currently. If you were in the trading room, I gave and I'm going to put this up here. Let me go to insert strategy real quick, or analysis, excuse me. I'm going to put the person's daily pivots real quick. All right, perfect. So if the market was supposed to be deemed to be a bullish day, now how do I get that information? How do I get the information that today was supposed to be a bullish day? Because the person's pivot indicator was targeting a higher red and a higher green. More importantly, you can see that blue line is above this gold line. So if the short term, or the pivot point, which I'm flashing on, is above the moving average pivot, then guess what? The market's deemed to be bullish. So if it's going to act bullish, it should break out and go. If it fails and generates a sell signal and gets back underneath pivot, the market generates a sell signal. Now, we gave a discretionary setup in the room, and I didn't yell this out to the gang, but it's nice to see the logic be able to be applied into an algorithmic automatic trading model that allows us to take those types of setups and to see those types of trades. Now, this again, it's not perfect. We could probably, some people, you know, can use it as an indicator only, but it does a couple neat things. It gets out at a profit objective, and that's what you see here. Orange is the stop, that's the entry, and that blue line right there is really important. If the market goes to that blue line and pops up, it's going to trigger a threshold of a trailing stop. If the market keeps going down without popping up, it's going to get out at the yellow line, which is the max profit target on 50% of the trade. Now, what's really cool is it's going to keep the other half of the trade going until something happens and or reverses the long in the market. And this is exactly what's happened. So this is kind of a neat trading algo system. Many of you guys have seen me talk about this. I'm just going to click on format strategy, and you can see there's a lot of things that we could do. We could play around with start time, end time, trade all times, let it go all the time, optimize what the best time is. I can just hit start time and end time and optimize when's the best time to take trades. Trail your stop 70% before it gets to its max profit target. Take reverse signals, yes or no. Take buy signals, sell signals, what kind? Use last conditional change. What's your max holding period? All of these functions are all optimizable and been programmed automatically into the Person Algo Optimizer. That's what's really insane about this, because this is not a trade, well, it's a trade system development product, but it's also a maintenance of a trade system. So when we get expansions and contractions and volatility, we can maintain our system. Maybe is if we start to see bonds finally get into a 1.5 or a 2 handle move, we can change and alter that profit target and expand and utilize what our risk reward ratios are, and that way we'll get a little bit more when conditions start to change. What I was getting at earlier in the presentation, remember, and I'm going to look at the E-mini S&Ps with you real quick, and if you look through this line right here, you will notice that the average true range right now is at 20.5 points for the S&Ps. Now, let me point something out to you. If you're an avid trader, and even if you're a stock trader, that's fine. But why do I look at the true range, or the average true range, which is basically what's the range and divided over time? The funny thing is we're finally in the S&P 500 right now at 20 points. With some of these days, like we had the other day, average, it means you take the last X period of time of days. What's funny is if you go back in October, many of you might remember this, we were at 7 points, 9 points for the 24 hours. Now let me go back in history. What I taught people at that 3-day seminar in 2015, we were crying like babies because the market wasn't really all that great to day trade, because we had an average true range for 6 months of the year at 22 points. 22 points in 2015. Normally, you're at 30, 35, 33. In 2015, when the stock market, it's now 25% higher, and the daily trading ranges are sniveled in, they were at one point cut in half of what we are normally used to. And it wasn't just S&Ps, it was gold, it was crude. The volatility of overall markets was extremely narrow. And I just wanted to point out, they're just now starting to expand. And by the way, back in May, so let's go back in May, in this period, this is April. In this period, April, May, we had a seminar in Las Vegas. the ATR was 22 points. I thought 22 points was bad. Step forward and get into this time frame, and you're talking 9 and 6 and 7 point. Overnight, you wake up the next morning and you're like, oh my God, the market has a 12-tick range from about 8 p.m. Eastern till 5:30 in the morning. Remember we went through that in October? It was brutal, right? There was like no price movement. Well, traders, we need price movement. And so that's where trading systems kind of break down. People can't maintain and adjust for that contraction or expansion in volatility. And that's what we have done to help traders, at least if not trade automatically, at least identify trade opportunities. And so with that said, this particular year, I think because of the advancements in the technology that's available to retail traders like you guys, and I know that the education level and your learning curve has been enormous. I mean, guys are grasping things. It's no longer simple, green crosses red, what do I do? You guys, the general public, is really catching on to this game, and it's doing amazing. And putting something like this in the right person's hand, I think a lot of people will see an expansion of being able to beat or catch up with the institutions at this game of A, number one, sector rotation, and B, number two, auto execution, and being able to identify trades and get in them and be able to say, hey, if I'm wrong, get out of them. And that's the key right there. If you let your winners ride, they're gonna take care of themselves. It's generally the losers that decimate us, right? So a system and algo optimization that allows us to participate in trades, that's the key. Anyway, I wanted to go over what was going on going forward from both a market perspective and what's happening here at Person's Planet. And I thank everybody for attending today. I hope you got something out of what we're anticipating from an event from both a fiscal standpoint, a monetary standpoint, a taxation standpoint, and again, seasonal aspects of what's making the market tick. Between semis, biotechs, the sectors that we see rotation. And by the way, I didn't even mention it. I got a minute. I did want to share that with you real quick. Silly things like consumer staples in the food group. The food group, one of the trades that we did earlier last month was probably, and you guys would laugh at me if I repeated, but in the consumer staples sector, I was looking at this stock right here called Hormel. And why I was looking at Hormel, and I'll share exactly why, and we did get in, and I got out a little early, but there was earnings, et cetera, et cetera. But one of the things that I kept saying is, as a kid, college, do you remember Hormel used to make chili? And I used to tell people, man, I don't even know if they still make chili, but Hormel made some really great chili. What was neat about Hormel is that we started to see the volume increase in Hormel, and it broke out of that last conditional change. And in the food group, consumer staple, another little thing that happened is this relative strength in the Person's market catcher on a daily basis. So this is the kind of, if I'm not going to be right in whether or not markets adhere to their seasonalities, I think at the very least I can kind of help guide you to what to look for in trades when they bottom out in a seasonal perspective. So markets that make newer lows, like we had the lows in September, we had newer lows in late October. Now, on balance volume, and I helped teach a lot of people how to use this, and quite frankly, something's going wacky with it. It's not as efficient as it once was, in my opinion. And that's why I developed this indicator, the volume indicator, which is in terms of, instead of actual numbers, it's in terms of percent changes. So clearly you can see Hormel was making a stronger, higher volume reading. We are having that convergence in volume. And another factor that was really important is the relative strength, and this is the PMC. And yes, we're working with TOS about getting this on TOS. This is an amazing product that helps keep us understanding the relationship between the relative strength of a market, whether it's leading, lagging, weakening, or improving. And obviously you can see if it starts to go in the fuchsia color, the relative strength against the stock to the S&P is improving. And then therefore, when it fires off a bright blue, it's starting to show that the relative strength is starting to outperform the market. So Hormel was a trade we thought, number one, what a great trade from both relative strength, volume analysis, seasonal analysis. More importantly, the risk-reward ratio was awesome. And so that was the trade that and how we came about finding Hormel. Now, I wanted to discuss that just a tad, and I'm sorry we're running out of time here, but the consumer staple sector, the XLP, this is a sector that does in the food groups, does quite well after the first of the year, and I hope by that time we get a chance to meet again. In the meantime, if you guys have an interest in furthering your education and what I have to offer, look for our special year-end Christmas catalog. And if you have more questions on the TradeStation application and the person's algo optimizer, please feel free to contact us at, you can get a hold of us at mperson at personsplanet.com, or just visit the website and said, hey gang, I'd like a little bit more information about that. With that said, that ends our time today. I hope everyone enjoyed and at least had some good insights in what tools are working, and I hope I achieved our goals of working together in this hour that we spent. Thank you, everybody. Have a great holiday if we don't see you, and Merry Christmas and happy, prosperous, and healthy New Year to everyone.